Well, good morning and welcome to the Reserve Bank. And with me, I've got John McDermott, who's the bank's chief economist and assistant governor. And I hope the press gallery Christmas party went well last night. I'm sure it went long. So the Reserve Bank today reduced the official cash rate by 25 basis points to 2.5%. Globally, economic growth is below average and inflation is low, despite highly stimulatory monetary conditions. Financial markets remain focused on weaker growth in emerging economies and on the expected tightening of policy in the United States. Growth in the New Zealand economy softened over 2015 due mainly to lower terms of trade. A recovery in export prices, the recent lift in confidence, and growing demand from the rising population should see growth strengthen over the coming year. The rise in the exchange rate since August has been unhelpful, and further depreciation would be appropriate in order to support growth. House price inflation in Auckland remains high, posing a financial stability risk, but there are some early signs that it may be moderating. CPI inflation is below the 1 to 3% target range, mainly due to the earlier strength in the New Zealand dollar and the 65% fall in world oil prices. The inflation rate is expected to move inside the target range from early 2016. There are many uncertainties and risks to this outlook. Dairy prices could remain weak for longer, and the current El Niño could deteriorate. On the other hand, net migration could stay high for longer, with household spending picking up on the back of strong house prices. Monetary policy needs to be accommodative to help ensure that future average inflation settles near the middle of the target range. We expect to achieve this at current interest rate settings, although we will reduce rates if circumstances warrant. We will continue to watch closely the emerging flow of economic data. So thanks very much. Happy to take questions. The judgment we've made is that, in essence, with all the uncertainties and risks around forecasting that we've talked about in the monetary policy statement, our central expectation is that we think that the current interest rate settings will move us back to our inflation objective over the medium term. And if we're wrong about that and situations evolve, you get new information all the time, then if that proves to be the case and we need to cut rates, then we will do so. I'd say the biggest risks are around China and global growth. The fact that, as I say, global growth's at its lowest since 2009, despite extraordinary monetary policy accommodation. Having said that, I think the perspectives on China have become more optimistic in the last 3 months, certainly since we got through the August equity market adjustment and some pretty unusual policy responses by the Chinese authorities. I'd say the El Niño, and there the risk is how long it goes for and where does it hit. So, for example, if it went through the summer months and into autumn, for example, and it affected the Waikato region and possibly Taranaki, then that could have significant effects. And so we spent quite a bit of time looking at the 97 El Niño impact, which we thought was around 0.75% of GDP in terms of lost output. But things are a lot different since 97. You've seen enormous amounts of irrigation put in Canterbury. And Canterbury is where the biggest increase in the dairy stock has occurred. So if Waikato and other regions got hit, then that could be a factor. I think the other risk is immigration is stronger for longer. I mean, we've seen something like roughly 110,000 increase in net permanent long-term migration of working age people. Our forecasts build in about another 120,000 over the next 3 years, which is a record amount for New Zealand. That's a huge cycle. Whether there's upside on those numbers, that would be a risk as well.